I took this 4-hour trade on Euro USD in the last couple of months by simply understanding external range liquidity and what happens with regards to price action around these key levels in the market. Let me show you exactly how I did this. So we can see that in this piece of price action, we have a sell-off for the month of October, and we get a close of a bearish monthly candle. This creates a candle range or a piece of price action that we can look to trade. Because as soon as this monthly candle closes, what it does is it creates a pocket of external liquidity the price can target in order to reverse. So that's exactly what happened. So if we just pick up price action, we can see that price targets, it breaks out below the monthly low. We then see a retracement, and then what price does is start to sell off. So what we're expecting to see, or what retail is expecting to see, is a continuation of this trend. But what happens at this point is that price tries to sustain lower prices, stings below this low, and then closes above the high. So at this point, we have a true market structure shift in the market. This corresponds with the liquidation of a candle's range and the targeting of external range liquidity that sits at the low of this candle. What we can then do is use internal range liquidity in this price leg to get involved in counter trend moves. So here we have a fair value gap. We have a swing point below the order block. So I place my stop loss right there, and then I target the high, which is the opposing end or the new pocket of external range liquidity that is created at the close of this bearish monthly candle. And that plays out for a 4-hour trade. So that is using external range liquidity and lower time frame price action to take high probability trades in the market. And you'll see that I'm executing on the 12-hour time frame, and I'm overlaying the monthly time frame. So I'm using higher time frame as my monthly candle, and then lower time frame in this instance as my 12-hour time frame. Let's just run through why this works. So quick definition of external range liquidity. External range liquidity refers to liquidity, in my eyes, that's sitting at the extremes of higher time frame candle ranges. So let's visualize this as either your daily candle, weekly candle, or monthly candle. And then we have our lower time frame price action that we're using to trade these higher time frame candles. The external range liquidity sits at the external ranges of our higher time frame candles. Why is it important? So external range liquidity works as a great place to take trades from because institutions target these areas, because this is where a huge amount of liquidity is resting in the market. So if I'm an institution and I want to fill my order, which consists of potentially over 100,000 units, I need to target big pockets of liquidity to fill those orders. Secondly, what happens around these levels is you get breakouts. So price breaks below the low. And in doing so, what it does is entices new entrants into the market. So more often than not, retail traders that think a continuation of the trend is going to occur. So this means that more actors get involved. They're placing, at this point, short positions in the market, and new liquidity is building that can then be sold into when these big institutions are distributing their positions in counter trend moves. So here's what you're looking for. Essentially, you have a key level on the chart. Let's imagine this is your monthly low. And then what you're looking for is price to trade towards your monthly low, break below, enticing new entrants into the market that are going to increase the level of liquidity in the market by putting stops right here. So stops, previously bullish stops, are being raided right now. More liquidity is entering the market. There's a retest of this price leg. Price tries to go lower. Supply in the market, given this is bearish, fails. Demand steps in, and then we're looking to take counter trend moves to target higher. So that's the pattern that we're looking for right here. That is the exact pattern we're looking for, and we need to ensure that we're targeting external range liquidity at old highs and lows on our higher time frames. With that said, let's look at a couple of more examples. So we've got a bullish example with NZD CHF. And you see the exact same thing playing out. So we have right here the close of a monthly candle right here. What price then does is it trades towards the low of this candle's range, the external range liquidity. So we are selling off at this point below this candle's low. And what we do in doing that is liquidate the low. So I'm just going to mark that in green so that we have a good view of that. So what we're potentially doing right now is exposing the previous candle's high as a longer term swing position trading target. So as soon as we then get our shift, whereby we retrace into the internal range liquidity in this price leg, fail to close below the low, and then see a true market structure shift, we're in a position to get involved. So here's our structure shift. I'll mark that in a different color so that it's clear. And at this point, we can then mark internal range liquidity points on our chart. So here you can see at this specific zone, we have the formation of a 12-hour order block in the market. So simply by entering on the order block, covering the low, we can then look to target the opposing end, the new external range liquidity that is being created. And that plays out for a 3.38R swing trade. So again, we have highs being respected, lows being broken through, a bearish trend. We have a breakout below an old low in the market, the monthly candle. Then we have a shift, new internal range liquidity created that we can then use to trade a counter trend move towards the high. Let's look at a bearish example before we close out. So on USD CAD right here, we have again the close of a candle that we can use to assume that or start to predict bearish price action above or targeting the external range liquidity that sits above its high. So initially we get a candle close, a monthly candle close, bullish. So at this point we're expecting higher prices. What then happens is price trades into the high. It breaks above the high. There is then some consolidation, and then eventually what happens is we get the formation of an uptrend right here. We trade back into this price leg, try to go higher, we retrace again, try to go higher, and then we get a sell-off. And this gives us our true market structure shift, again, right here. So let's mark that in the same color for consistency. Then we get the creation of internal range liquidity. So you can see that in this bearish price leg, a bearish fair value gap gets created. This then gets stung into, so we can use that as our entry point for the trade, and we can then use a conservative stop which covers the liquidation above this high. We then target the opposing end of the range. So as soon as we've manipulated this candle's range, this becomes our primary trading target for 2.69R. And what you'll see is that often when we get these sell-offs, we can then target additional targets in the form of even higher time frame external range liquidity. So this might be external range liquidity on, say, the 3-month chart. If you're interested in learning more about trading candle ranges, swing trading, and the mechanics of effective trading strategies, then please subscribe. I'm releasing a lot of content that fully unpicks all of these aspects in detail. Look forward to seeing you on the next one.